Hey guys, welcome back to Stock Tricks with Nick. As quarantine continues, the unemployment rate has skyrocketed, the economy has grinded to a halt, and the flow of money has been turned off. To deal with this, the Federal Reserve has taken countless measures to try and stimulate the economy. This ranges from bailing out failed companies who decided to buy back their shares instead of building a cash reserve, like a financially responsible company, sending out stimulus checks to those Americans who earn less than $99,000 a year, freezing federal student loans and their interest payments, or making loans available for small businesses. Many of these topics I've covered in previous videos, so make sure you check those out once you're done here. Today I'll be covering what the Federal Reserve has been doing with banks, the pros and cons of each of their decisions, and a nearly risk-free way to earn interest on your emergency fund. The first step that the Federal Reserve, or the Fed, took when the economy started shutting down was to decrease the federal interest rates to 0%. They did this on March 14th and hoped to stimulate the economy. For a quick definition, the Federal Reserve interest rate is the rate that banks charge other banks for loaning money overnight. You see, in the past, banks had to hold a certain percentage of all their customers' deposits at their own bank. This percentage is called the reserve requirement ratio. And we'll get back to this in a little bit. If a bank is holding less than their reserve requirement ratio after they close, they'll have to take a loan out from another bank who has excess money over their own reserve requirement ratio for the night. The rate of interest that the borrowing bank will give to the lending bank is the Federal Reserve interest rate. So how does decreasing the Federal Reserve interest rate impact you? By having a lower base for interest rates, lenders across loan types will charge less interest rates on similar risks. In theory, you would get lower interest rates on a mortgage, on buying a car, going to school, and credit card debt. In the real world, you usually see this impact on mortgages and student debt, but not so much for the credit card companies. That's another reason why you should not hold a credit card balance between months. With lower rates, people are more likely to take out a loan to buy a car, buy a house, go to school, or buy something they don't need. Either way, it stimulates the economy and gets the cash flowing. Those are the pros. The downside to this is that it hurts banks and people that save. With banks earning less interest on the money they loan out, they're less incentivized to collect deposits from a larger group of people. If they're not as hungry for customers to bank with them, they'll provide lower savings account interest rates. This is how this hurts you, the financially sound, living below your means American. You've been spending responsibly and putting a portion of your income away in a savings account, which until recently, earned a decent, risk-free return. But as banks are earning less on their loans, they're lowering the interest rate on these savings accounts. Because again, they don't need your money. With every decision the Federal Reserve makes, there are pros and there are cons. And it's important to talk through and understand the consequences before they make these decisions. Okay, with that move done, people are upset about their savings accounts, and the economy is still not moving. But it's okay. The Federal Reserve has another bright idea. Previously, the Fed had a law that restricted the number of withdrawals that you can make from your savings account each month at 6. Any more than that, and you would be penalized for taking your own money out. They had this restriction in place, so Americans would be forced to be financially responsible. They would be incentivized to save more and leave their savings there instead of pulling it out for something they don't need. Since the Federal Reserve lowered their interest rates to 0%, the savings account interest rates are at record lows, so the difference between a savings account and a checking account has been reduced. Because of this, and the fact that the Fed wants Americans to start spending again, they've changed their stance on the withdrawal limit. Now it's up to the individual bank to see if they have a limit on the withdrawals from the savings account. Short term, I'm all about this idea. For people who've been saving in the past but are hit with financial hardship now, whether it be unemployment or a reduced income, they need access to this extra cash. I'm not sure who's dipping into their savings account more than 6 times a month, but if it gives someone the right to get to their own money without being penalized to survive, I'm all about it. Now for the cons. I think this could have a poor long-term impact for Americans. Pre-virus America had a huge spending problem. The average credit card debt for an American family has never been this high. We've completely normalized living in debt, and 1/3 of Americans are living paycheck to paycheck. Yes, there are factors that contribute to each individual situation, and we do have an income problem, but for a lot of Americans, that wasn't the issue. Look at the distribution of people living paycheck to paycheck across income levels. Notice anything? It doesn't matter how much you make in this country. About 1/3 of each income level is living paycheck to paycheck. That is absurd and irresponsible. 3 things to always remember. Live on less than you make, get out of debt as quickly as possible, and grow an emergency fund. But enough of that rant. Let's get back to the savings account issue. If America already had a problem saving, and the Federal Reserve doesn't put the restriction back once the virus subsides, how many Americans are going to be worse at savings? Like I said earlier, I'm for this action now, but once people are allowed to go back to work, we need to put these incentives back in place to get Americans to start saving and living below their means. Okay, so far the Fed has pulled 2 levers for the banks, and the economy's still frozen. But wait a second, here's a great idea. What if we just lowered the reserve requirement ratio? That way, banks are incentivized to loan out as much money as they can and get the economy going that way. Do you remember that reserve requirement ratio from earlier? It's the percent of money that banks have to hold compared to the entire sum of their customers' deposits. Pre-virus, banks that had deposit totals under 16.9 million didn't have to keep any required money. Then, banks from that 16.9 million to 127.5 million just had to keep 3% overnight. And finally, for the largest banks, those with deposit amounts over 127.5 million had to keep just 10%. Even these rates seem absurdly low to me. Only holding 10% of deposits as liquid cash just seems irresponsible. What if there's an influx of people trying to get their money out of the bank in an emergency? This is probably just me being overly cautious, but as an actuary, that's what I'm supposed to do. Doesn't matter what I think though, the Fed already made their decision. Starting on March 26th of this year, the Federal Reserve lowered that reserve requirement ratio to 0%. Yes, 0%. But before we all panic, this is just the Federal Reserve requirement. Any financially sound bank is going to hold an excess amount to this level. Just like an individual citizen, holding cash during a crisis is extremely beneficial. But let's play out a worst case scenario here. Say you deposit your money at Bank Irresponsible. Bank Irresponsible is upset that they're not earning the same types of profit by loaning their money out because the Federal Reserve lowered their interest rates to 0%. To make up for this lost profit, Bank Irresponsible has a great idea. They're just going to loan money out to as many people as they can. And if a person or company is deemed more risky, then they can charge a higher interest rate and get their money back even quicker. Or say they kept their underwriting standards and is just loaning out money to as many people that would have been deemed safe in the past. You don't think that with companies being forced to shut down for an extended period of time, and with unemployment skyrocketing, that more people aren't going to default on their loans? The more people defaulting, the less money Bank Irresponsible is taking in. And because they are leveraging as much money as they can, each default is that much more impactful. Now, as an individual, you'll never have to worry about getting your money out of Bank Irresponsible. The federal government showed us in 2008 that they're just going to bail out any large financial company that takes irresponsible risk and fail. The more companies that the government bails out, the more money the Federal Reserve has to print, and then the value of each dollar you have falls. This is called inflation. This is one of the levers that the Federal Reserve pulled that I'm opposed to. I think the risks here far outweigh the benefits, but I'm not stuck in my opinion. If you think this is a good move by the federal government, comment below why you think that. During this video, I've been showing the pros and cons of each decision, so I would love to discuss what you're thinking. A safe alternative that I take to keep my money working for me outside of a bank is investing in SHV with any money that I'm not trading stocks with. SHV is the ticker for the iShares Short Treasury Bond ETF. This ETF is made up of 48 holdings of the shortest end of the yield curve. It focuses on US Treasuries with maturities between 1 month and 1 year. About 71% of the fund is invested in these holdings, with the remaining 29% in cash or derivatives. This ETF has a AAA bond rating. That's the highest given, and it returns dividends monthly, which annualized brings 1.4% guaranteed return to your portfolio. This is still lower than some high-yield savings accounts, but if you're actively trading, this is a great place to store your cash and earn a little bit of interest until your next move. Thanks for tuning in to Stock Tricks with Nick. We covered a lot today, so if you have any questions, comment them below and I'll get to each one. Especially if you disagree with me. Comment your side below so I can research another side of these complex issues. If you learned anything from this video, please like and subscribe to my channel, where I make weekly finance videos like the one you just watched and weekly stock trading recaps. Stay safe and see you next time.